Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul, here we go, man. Another episode. How's it going?
What's up? How you doing?
I'm good. Feeling good. Feeling better than you sound. Sounds like your voice is a little under the weather there.
You know, Carmelo vomited this morning, so that was great, and then did it again. But I think I'm still recovering from Alumni Weekend. I was up in Vermont a couple weeks ago for our 20th, and just a lot of laughing and screaming, and
Oh, that'll do it.
I'd like to say debauchery, but there really wasn't.
No, you're too old for that.
Yeah.
A 20-year college reunion is
Yeah.
You're not a spring chicken anymore, as they say.
No,
Sounds like something James would say.
that's right.
Yeah. Well, cool. Drink some water. Drink some lemon water.
I got it.
Because we got some talking to do. All right. Well, let's start, man. I'm going to start with a question that I got this week from Michael. And he sent me several, but this is a good one to lead into, some things we can talk about today. He says, is it possible to purchase a policy in one lump sum, like a one payment policy? So I think this is a common question people often ask because it really shows that they haven't researched the infinite banking concept, right? Because the entire goal is to pay premium for as long as possible, right?
Yes.
So it's somebody that obviously with that question, it means you don't quite understand it yet, Michael. Read the book. Probably haven't read the book. But the answer to that question is yes. Yeah, of course. You can pay a single pay policy, pay it one time and be done with it, right? But what's the problem with that? What's going to happen?
Yeah. Well, it'll become what's called a modified endowment contract, and we call that a MEC. And unfortunately, what happens when you do that is you lose the tax favorable status that whole life insurance enjoys, right? So it gets treated more like a traditional qualified plan or traditional IRA. You get the 59.5 rules. You've got taxable income now. Your loans are taxable. It's last in, first out, right? There's almost no reason to do it. But I want to talk the history real quick. It used to be extremely popular, and that's why the government put a stop to it.
Because it was a great thing, right?
It's a great thing, right?
Like, man, I wish I could go back to the 80s and I had the money and I was
Right.
old enough to put money into something like this because, yeah, back in the early 80s and before, that didn't exist, that MEC rule. But what happened is, life insurance was so favorable that so many wealthy people, and maybe not even wealthy people, anybody who had somebody teaching them or an advisor saying, hey, this is a great place to put money, was put money in there and immediately growing that cash value and immediately being able to access it tax-free.
Right.
And the IRS, of course, I saw a little meme this week, a little funny cartoon going around LinkedIn. There was a sign behind the IRS person's desk, and it said "the IRS," and the taxpayers on the other side of the desk. The husband turned to the wife and said, "See, honey, I told you it's theirs." Like the
pretty
IRS
clever.
spells theirs. Yeah, very clever, right?
Yeah.
But they saw, wow, this is too good, so we're gonna have to put a stop to that. So they implemented the MEC rule. So, what's the purpose of the MEC, Paul? According to why did the IRS do that? Other than they want to take more of our money.
Oh, I thought that was the main reason.
That is the main reason. But how do they define the MEC? Like when we talk about MEC, where does that come into play?
Are we talking 7-pay test?
Yeah, that, and then the death benefit and versus the premium and all that. Yeah, right.
Sure. Okay. Yeah. So I don't want to get too into the weeds, but basically the IRS has these calculations, the 7-pay test, where there has to be a certain premium to death benefit ratio when purchasing whole life insurance, right? So the single premium that Michael's question is about doesn't meet the 7-pay test, right? So that in the IRS's eyes, right, they're saying, hey, he's not really buying life insurance. This is more of an investment product, right, for him, right,
Yeah.
or a qualified plan type of environment. So it gets taxed accordingly under those rules. So it is life insurance. The death benefit is still a income tax free to the beneficiary, right? But everything else, policy loans, withdrawals, we have dividends that are still going to be paid on these policies. Those all lose their tax favored status, which is it's a very rare occasion where I'll recommend a single premium policy. Not saying it's not going to happen, but it's going to be a very special case.
Right. I mean, the only time I would think, like, if my only two choices were, hey, I had $1 million lump sum that I needed to put into something, and it was either I can throw it in the market or put it in a mutual fund or put it into life insurance, I'd put it into life insurance in a heartbeat, because in either case, you're going to be paying taxes on the earnings.
Yeah.
But
and you maintain your liquidity and you still have access to that cash.
exactly. So,
Albeit under taxable events, there's those 59 and a half, age 59 and a half rules as well that you have to abide by.
right.
Right. So that's, add whatever tax you're paying, right? Add the 10% penalty on top of it.
Yeah. So when we design infinite banking style policies, we design these to what, as Nelson says, snuggle up to the MEC line, but don't cross it. So what he means by that is we are trying to, like the intro says to this podcast, we're flipping everything on its head financially. So most people think of insurance of any kind. I want the most insurance coverage for the least amount of premium, which makes a lot of sense in almost every case of insurance.
Sure.
Except for when it comes to permanent life insurance, if you're going to use it as a banking system, like we designed them to be. So we do the exact opposite. We try to put in as much premium as possible for the smallest amount of death benefit. And like you said, the IRS is classified saying like, hey, if I want to put in $50,000 a year, there's a minimum amount of threshold of death benefit I have to have so that the IRS does not qualify, does not say that, hey, that's a MEC. We've got to prove that the primary purpose is buying this for the life insurance. So, so we design these policies to snuggle up to that MEC line. So get as much premium in there, minimize the death benefit as much as possible. In general, we're all obviously going to take that into account because people need to be insured. But you minimize that in order to maximize the banking function and the capitalization period and all of that for the policy. And that's where the MEC comes into play. And when we design these policies, it's more or less guaranteed that it's not going to MEC. Unless like, how could any of the policies that we design MEC, Paul?
Yeah. Well, you could run into a scenario where, you've put in X amount of dollars and you've taken like what we call maybe a maximum allowable policy loan, right? Which is going to start to accrue interest every year, right? Interest is going to be on top of that loan every year. It's going to compound. Well, if you run into a situation
if you don't
make no loan repayments, right,
or interest payments at all,
right,
yeah,
right. Where so if the balance of that loan plus the interest, is going to exceed the cash value in the policy, then you're going to get a phone call from me probably. Well, you're not doing infinite banking. How dare you? But
so you probably got a phone call a lot earlier than that from Paul.
Oh, no question. Yeah, no question. You're stealing the peas. You're breaking all Nelson's rules, right? You're stealing the peas. You're not being an honest banker. And you're clearly afraid to capitalize, right? So, but anyway, that could become a taxable event if that policy lapses, right? If you don't do something like make a loan repayment or do something to cause that not to collapse, then yeah, you're going to have a taxable event.
Yeah, right. So, and we've been mentioning the IRS and tax code and everything. Let's not forget that whole life insurance, when properly designed, it's not a tax loophole that is creating this wonderful benefit that we call properly designed dividend paying whole life insurance. right? There's no loophole in the
It's not an
tax
exception.
code.
Right.
It's not an exception. That's just the way it is. Life insurance has been around much longer than the IRS, much longer than income tax. So it's not a loophole. That's just the way it's classified and has always been classified.
Right. And any loan you take, whether you go to finance a car traditionally, you go to the finance guy at the dealership and he gives you a loan. Well, that loan's not taxed as income, right?
Right.
Just like that's why, policy loans are no different. You're borrowing money from the life insurance company. That's not going to be a taxable event unless your policy's a MEC.
Right. So, I mean, if they started taxing loans, then the economy would shut down.
Correct.
Who would borrow money if that's going to be, I'm going to go borrow $600,000 to buy a house and then I get taxed on $600,000 of income that year? No, it's not going to happen. Right.
Gosh, I hope they're not thinking about that.
Well, they're thinking about taxing unrealized gains, so I wouldn't put it past those Marxists.
Unbelievable.
Yeah. So that kind of answered Michael's, actually, one of his other questions is what happens if I don't pay back the policy loans? So, well, if you don't pay back the policy loans, one, you're not doing infinite banking, just like you said, Paul. Two, you could get yourself into this situation after a long period of time of creating a MEC in your policy. But barring that, let's say you don't steal the peas, you do play honest banker with yourself, you will not MEC these policies in the way they're designed. In fact, they're guaranteed. I've asked the company multiple times, if somebody pays too much in a single year, and more than they're allowed to, and you apply it to the policy is going to MEC, right? And they're like, no, of course not. We will not fund these things more than what they're allowed to up to the MEC line. If you overpay, they simply send you a letter saying, hey, you overpaid by $2,000. What do you want to do with this $2,000? You want us to send it back to you, or apply it to an outstanding loan, or save it for next year?
Right.
Yeah.
That's right. Yeah, they do. They basically do a MEC test. That's why you want a good company to do IBC through that does those things, right?
Yeah, and more importantly, a good agent who knows what the heck they're doing to make sure it's not a MEC and it never will become a MEC.
That's right.
So because what's the rule? Once a MEC, always a MEC.
Always a MEC. Yep.
So you can't, if you have a policy, and we talk to a lot of people who have permanent insurance policies, whether they're whole life policies or IULs or some other garbage. And they come to us and they say, hey, what can I do with this policy? And there are some options, but the first thing I always want to find out, well, is that a MEC or not? Because you can't take that MEC policy, we can't 1035 that into a brand new, properly structured whole life policy and turn a MEC into a non-MEC. It's just,
That's right.
it's dead on arrival.
That's right.
Yeah.
You'd have to just surrender that policy for cash after getting underwritten for a new policy that can accept that cash, right?
Right.
That'd be the best option.
Yep.
Or keep funding that IUL.
Yeah. So once a MEC, always a MEC. Hopefully that's not too much information for people. We don't want to get too deep in the details because really it's a moot point. You do not need to worry about it whatsoever.
Yeah, I always tell my... Oh, sorry. Go ahead.
If you find the right person to design the policies for you, an IBC practitioner, and if you're playing honest banker, you don't have to worry.
That's right. That's right. A lot of this question comes up, Dave, on the MEC thing is people think it's associated with a dollar amount of premium. Like, hey, if I pay $50,000 in premium, is that going to be a MEC? And they're just misunderstanding what it actually is. You could have a policy that's a MEC that's $1,200 a year.
Yeah.
Or it could be $1 million a year. It's the design of the policy or the fact that it was a single pay policy that creates the MEC status, not the dollar amount.
Right.
I just want to make sure that people understand that.
Yep. Good clarification. Well, so what else? I could go through the other questions that Michael has here.
Yeah, let's do it.
Yeah, he says, when you borrow from a whole life insurance policy, do you pay interest on the loan? So again, he hasn't read the book. But there is some confusion around the interest. Like anybody who understands even the little bit of IBC knows that, yes, of course, you're paying interest on that loan because you're borrowing somebody else's money.
Yes,
Right?
that's correct.
So, but there is, and I've, even people who have been practicing this for years, not as IBC practitioners, but just users, policy owners,
Sure.
right? Because maybe they misunderstood, or the person explaining to them, maybe it was their misunderstanding, and they passed it on to the policy holder and try to make it sound like too good to be true, or much, something that it's not.
Right.
Which is, hey, when you pay this interest back to yourself, it actually increases the value of your policy, which would mean that taking policy loans and repaying them would actually make your policy perform better than if you never took a loan, right? Which is not the case.
Not the case. I suppose that one could argue indirectly by taking a loan at whatever X percentage, if that percentage were higher, like the interest rate they're charging you at the insurance company is higher than the insurance company can earn in its overall general portfolio of bonds and stuff, you're helping make that company profitable, which is paying you a dividend, which is giving you money in the end, right? But no, it's not adding value to the policy just through the act of borrowing the life insurance company's money.
Right.
It doesn't at all. The only way to add value to a policy is through premium, whether that's PUA premium, whether it's the annual dividend, or if you're structured for cash value, right, where half your premium maybe is going to another paid up additions rider, excuse me. That's adding value to the policy. Your base premium is adding value to the policy, but you can only add value to the policy through premium.
Right. Which goes back to the question of, some people who say, hey, I've got this cash value, and they start learning about this idea because maybe they started these policies and they didn't really realize that they could use that cash value to finance their lives and their purchases through life. So they've been doing that because they're very conservative and they want a long-term, like a retirement plan. And then they're putting money in savings in a bank over here. And they say, well, hey, I'm going to go buy a new set of golf clubs for $1,200. Hey, I learned about this banking thing. I'm going to go borrow $1,200 against my policy to go buy that and then pay myself back, instead of using the $50,000 I have saved up in my savings account over here at the bank. And that, it just doesn't make sense, because
Right. They think they're adding value, but
you're not.
they're not.
Yeah,
not.
because they would take that $1,200 loan, go buy the golf clubs, and then they'd repay that loan, but they got $50,000, so they would just take $1,200 for their $50,000 to go repay that. And all they did was pay, 5% interest on the week or two that they had that money out in a loan. Like, it doesn't make any sense.
Right. You just paid a little too much for those golf clubs.
Right. Yeah. So
No, I think it's an important point to bring up, because a lot of people, that's a question I field generally fairly early in the process after they've done some reading. They've read Nelson's book, and they need to read it again. But because he does say, hey, the additional interest that we're paying back, right, is premiums to the life insurance company. That's how we add to the capital base of our system, right?
Yeah.
So, but super important distinction and point to bring up. Otherwise, it would be the greatest thing ever, and it also wouldn't exist because the insurance
Right.
companies would go broke in a week.
Yeah. So using policy loans for the sake of using loans is not benefiting you at all. Using policy loans because that's the only place you're accumulating capital, because you've created enough room in your series of life insurance policies to capture all of your capital that that you're putting away for purchases and investments and everything else. That's when it's beneficial to you. Really, what it benefits you is, like, you can't improve the performance of your policy by taking loans, like we already established, but you can improve the performance of your overall lifetime wealth building by utilizing policy loans versus paying cash or financing at an outside institution. That's what you're doing.
Yeah, without a doubt.
Yeah.
If you did nothing else but what Nelson kind of is telling us in this book and recapture, that 34.5 cents out of every dollar throughout our lifetime just by doing IBC through properly structured dividend paying whole life, you'll be so much farther ahead than you otherwise would have been just investing 10% of your income or whatever.
Oh, yeah, without a doubt. And then chasing that high rate of return.
Right.
So, gosh, how many studies have there been where, there's been 15, 20-year periods where stock market has gained zero, It started here, took a big dip, and then it took another 10 years to climb back up to where it started before.
Yeah, a lot of folks don't do the calculations. They don't realize how much higher rate of return you need to earn in the following years after a significant loss.
Oh yeah. Yeah. A significant amount. And that's all fine and dandy if you're 20 years old, but what about when you're 60? When you're 65, you're retired, you're 70, and you still got 15, 20 years left on this earth. You're not adding any more money to those accounts. You're only taking money
Right.
out. And how are you going to be able to survive a 20-year drought?
You're not.
You're not. So talk about timing the market. The advisors always say, you can't time the market. Don't time the market. Yet they're telling you that they can time the market and telling you that everything's going to be fine in retirement if you just do all of this for 40 years with them.
Yeah, Dave, the more and more I look at these strategies where we're doing what used to be the 4% rule, now it's the whatever percent rule based on what the market's doing. And I don't understand how that actually people are lapping that up. Like, yeah, don't worry. You can take out 4%. The market's going to average 6. You'll never run out of money. Or, hey, look, we've illustrated you running out of money at age 100 or age 95.
Yeah.
Just,
Yeah. The thing that
seems
kills
silly.
me, it's like the government lies to you repeatedly. The news stations, the media lies to you repeatedly, yet you still trust them. The stock market disappoints you repeatedly. Everything your broker says turns out to be inaccurate multiple times, yet we still trust them. But if you and I are buddies, if you lied to me repeatedly, we would no longer be buddies. In fact, we wouldn't even be in contact anymore. I'd be done with
That's
you.
right. That's
Because
right.
I'm not going to deal with a person who I can't trust.
That's right.
Yet it's like, I don't know, is it Stockholm syndrome or maybe another one I don't want to mention, but like somebody who just is abused over and over and over, and they just think that's the way it is. Like that's kind of
Well,
where we
yeah,
are financially.
We're accustomed to thinking a certain way. Our education system isn't meeting the mark anymore, right? Like we have people that cannot critically think,
Right.
that cannot think for themselves, and so it's not surprising. It's not surprising that this is what is occurring in the financial space.
Yeah.
Just continue to do the same thing over and over again, expecting different results.
Yeah. Well, and I think mostly it's because people don't know that there is another option. There are
like
other
us,
options.
we didn't know.
We didn't know, and maybe it was for lack of looking for a long time. Like I just put money aside and gave it away to somebody else to
Right.
manage and didn't worry about it until you kind of peek behind the curtain, or you get somebody red pills you, and then you can't unhear it and unsee it. So you're like, guess I got to go down this rabbit hole and see where it leads. And so I guess that's what we're trying to do, is just give everybody a little piece of information that's going to be enough for them to say, hey, maybe there's something different.
Sure.
Yeah. Hopefully we accomplish that with what we're doing. And if anybody else listening wants to pass these podcasts on to somebody else in your network who maybe could use just a little nudge to think just slightly different, I think they're going to thank you in the long term.
Yeah. I don't think anyone would ever object to, hey, how would you feel about putting your money in a place that only you control? Would that interest you?
Well,
Yes.
what if I'm afraid to control my own money?
Well, then I probably can't talk to you. You have to, this is not for, IBC is for a very disciplined person. It is not for the indisciplined.
Right.
Does that make sense? I can't help that person that doesn't want more, or
Yeah.
doesn't want to take that. A lot of people you're right. They're just kind of, hey, I'm on cruise control. I'm, every month this is getting taken out of my check, going into my 401k. This money's coming out of my check and going to my Roth or my traditional IRA that I set up for myself or whatever. And they just it's just easy. They don't even have to think about it.
Yeah.
And
My
then once
annual.
a year they have their checkup.
Yeah, and they tell me
and
everything looks good.
everything's good.
Keep doing what you're
Cholesterol's
doing.
good. Blood
Yeah.
pressure's good.
Yeah, right. Keep
and,
doing what you're doing.
hey, I know the Dow went down, 25% in the last 12 months, but don't worry, it'll come back. We don't know when or
Don't worry.
whatever.
Let me get talking point number 3. The market always goes up long term.
That's
So
right. Generally speaking.
talking point number 4, invest for the long term. Everything's going to be okay, Paul. Yeah.
Buy term and invest the difference.
We use a little bit of sarcasm on the show, folks.
Yeah.
Yeah.
It's okay.
That's who we are. All right. Well, cool, man. I think that was good. There's probably enough MEC talk for one day for everybody. Unless you got any closing arguments, but I think we covered that MEC pretty
No,
well.
I mean, Nelson talks about it on page 38. He's got a little chart there about the modified endowment contract, and he's kind of talking about IBC and how where it is in time and space that policy should kind of sit.
Yeah.
So that always generates questions.
And the bottom line is, if you're using the right agent to design these for you and coach you in the process, and you're playing honest banker with yourself, you have zero to worry about when it comes to MEC. You're always going to have this ability to borrow, take cash value loans completely tax-free.
That's right. And it's good to be aware of it, I would say. And I think that
Sure.
shows that people are paying attention to what they're reading, which is great. But I've had a few clients who I love, but we spent way too much time talking about the modified endowment contract.
Yeah, don't get tripped up in the details, folks. Like, this is not that important if you're working with the right person.
Right.
Like, it's okay. Yeah, I'm covered. I covered MEC, check, covered. Not a concern anymore. Let's move on.
Let's move on.
Yeah.
Yeah, exactly right.
So, speaking of moving on, I got to go get some dinner and head off to football practice. So, we're on a 3-game losing streak that we really got to get back, man. It's tough.
Got to dig down deep, boys.
I tell you, we started the season with like 16 kids. One kid just didn't show up. One kid got a concussion and quit for the season. And then we've had like 1 or 2 injured every single game. So we're like Iron Man. It's nine-man football for
Playing
10-year-olds.
both sides of the ball here.
They are like over half the team's playing Iron Man every day, and these kids are.
Yeah.
It's painful for them, but they got heart. It's a lot of fun. Win or lose, it's a ton of fun, and it's just fun to teach the kids about, win well and lose well, but learn something when you lose.
Sure.
Yeah.
Yeah, absolutely. Great lessons.
Yeah. And they're 10 years old, so I can still outrun them and show off, like making cool catches with them. I'm like, hey. So, give it another 2 years and there's no way that's happening.
I thought you didn't run ever.
I choose not to run. I'll run routes to catch balls. That's about it.
Okay.
Yeah.
All right.
Otherwise, I just walk, man.
What's your route? Slant?
All of them. I can do them
All of them?
Oh yeah.
I don't think people knew you were a wide receiver.
I played wide receiver in college for a couple years at the Air Force Academy, and then tore my ACL and decided I'd rather fly than try to get on the field. I was on the meat squad anyway. So
I'll have to tell you a joke after we get off air about that.
yeah, I knew there was a joke behind there.
It's from the 80s, so you know it's good.
Yeah. All right. Well, we better cut it off here, and then you can tell me the joke. So, all right, everybody.
brother.
Yeah, we'll see you next week.
Later. Bye.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.